Good afternoon and good morning to all, and a very warm welcome to our results and strategic update for the year ended 31 December 2021. There are forward-looking statements in this presentation, so please take note of the safe harbor statement. The agenda for today is safety and ESG first. Those are our single and most important priorities. I will be assisted in presenting that section by Jevon Martin and Grant Stewart. I'll then do a strategic update which is titled Positioning for Positive Impact, and I think you will find that very interesting. We do use our year-end results to provide strategic guidance to the market and our shareholders. I will then hand over to Dr. Richard Stewart, our Chief Operating Officer, who will present the results of the operations in detail. As you can see, we've called it operational excellence. We've had an outstanding year considering all the challenges of COVID and safety and so on. Richard will then hand over to our CFO, Charl Cater, who will then conduct the financial review, which I think you will also enjoy. An outstanding year from a financial perspective as well. And then I'll wrap up with a brief outlook and conclusion. So as I said, let's start with safety, and it gives me absolutely no pleasure to talk about fatalities. We've had a very, very tough year where we've lost 20 of our colleagues throughout the group, tragically, in 15 incidents. A majority of those happened in the second half of the year, and we really stepped in and took very decisive actions, including in October, a 5-day suspension of all operations across the group to audit workplaces, refresh safety focus. And then in December, we actually shut down portions of our operations in the gold sector at Kloof 1 shaft, Beatrix 1 and 3 shaft, and then a partial closure at Driefontein to arrest these unacceptable incidents. We had to do the same within our South African PGM business, and one of those shafts, Thembelani, was a result of a lack of supervision due to COVID-19, and we just deemed it inappropriate to try and operate with sufficient supervision. So COVID has had a very significant impact. At the same time, we conducted an independent review, and that review, I'm pleased to say, confirmed the appropriateness of the group safety strategy and its systems, and in fact confirmed that it is aligned and consistent with global industry standards and practices. So that gave us the confidence that we don't have a flawed safety approach. We did, through that independent assessment, identify opportunities to further operationalize and institutionalize the commitment and responsibility for safety among the line management of the organization. And at the same time, we have developed a very comprehensive fatal elimination plan, which is being rolled out, and I have no doubt will have a very positive impact on reducing fatalities. So we are totally focused on our efforts to get to zero harm. I think it's always important when you have these type of dramatic and very serious incidents to look at the underlying data, and I do get confidence from the fact that we are clearly doing many of the right things. It doesn't change the fact that we lost 20 of our employees. But if you look at the rate of increase in the left-hand graph of our workforce, you can see the rate of increase in terms of the number of employees in the group is much higher than the rate of increase in fatality. So it does mean we are having a positive impact on fatalities. In fact, if you go to the graph on the right-hand side, the fatality injury frequency rate, and you look at a 3-year rolling average, again, you can see that we are moving in the right direction, which is what inspires us to continue on this road to zero harm. I think it's also important to note that, we do lump all our fatalities together, but we need to remember we have a very substantial PGM division, both in South Africa and in the US, and of course we have a large gold business as well. And what's very clear to us is that the gold business is challenging, being ultra deep, but we also notice something else, and I've seen references in other CEO presentations to the industry in general, whether it's in South Africa or in the US, is also regressing or regressed in 2021. If you look at South Africa, it regressed by about 22%, and in the US it regressed by 25%. So there is something behind the current regression that seems to be an international issue regarding safety. Nevertheless, we remain very focused on making a difference. And as I say, we do look for confidence and comfort in the things that we are doing along this journey. If you look at some of the highlights, all our operations received ISO 45001 and 14001 accreditation. We have seen an improving trend in all injury frequency measures since H1 of 2021, and of course injuries build up to fatalities. So if you can reduce injuries, you are certainly moving in the right direction. We also had a number of safety milestones, such as at Marikana, we achieved 4 million fatality-free shifts. At Kloof-Lower, one of our deepest operations, we went scratch-free for 6 weeks. And of course, the more you can duplicate this, the more you're going to impact on reducing injuries and hence reducing fatalities. And then at our surface processing business, we achieved 13 million fatality-free shifts on the 16th of September 2021. So those give us the confidence to continue down this very challenging and tough road to zero harm. Last year, I presented our sustainability strategy as a basis for our ongoing commitment to ESG excellence. And in fact, the basis of our green metal strategy is based on the sustainability strategy. And last year I presented building a green metals business, and I will just recap on that briefly shortly. But today what we wanted to share with you in more detail was our road to carbon neutrality. We've made good progress since we made the commitments earlier last year to get to carbon neutrality by 2040. We can certainly believe, and we certainly do believe we can do that much earlier. And then we've really made some outstanding progress on water demand and intensity, and Grant Stewart will present that to you. Just as I said, I wanted to just remind you of building a green metals portfolio, and that's based on building a climate change resilient business. And we've made, again, significant progress, and nothing has changed in terms of our focus area. As we said last time, we spent 2 years doing due diligence before we entered the battery metals market. We did 4 transactions in 2021, Keliber, Sandouville, the Rhyolite Ridge project, and the acquisition of a stake in New Century. Just to remind you again, the battery metals together with the PGMs will provide a very significant green metals portfolio. We do intend to complement that with other metals such as copper, maybe manganese. Uranium is a byproduct of gold, and we are working on our uranium strategy, but nuclear energy is now considered green, and therefore the underlying metal must be considered green as well. And to complement that, we have advanced our thinking in recycling, and of course tailings retreatment is another area that is similar to recycling, but we do and we are increasing our exposure in the circular economy. So that's the basis on which we make acquisitions, and it's the basis on which we will enhance our green credentials. So at this stage, I'm going to hand over to Jevon Martin to talk to you regarding our path to carbon neutrality by 2040. Thanks, Jevon.
Thanks, Neil. Sibanye-Stillwater believes climate change to be the most pressing threat to our planet and global challenge of our time, as recognized by the Paris Agreement and the UN Sustainable Development Goals. As a force for good, Sibanye-Stillwater has a role to play in the urgent global response to the threat of climate change, and as such, we have aligned our governance, strategy, risk management, and targets across the group to align with the recommendations of the TCFD. First and foremost, we produce green metals, as Neil's indicated, that support in the reduction of greenhouse gases and the reversal of climate change. In 2021, we committed to achieving carbon neutrality by 2040 in advance of the requirements of climate science. Over the last year, we have refined our pathway and supporting interventions and have grown in confidence in our ability to deliver on this commitment. In the graph depicted here, we have forecasted our greenhouse gas emissions profile over the life of our mines based on a bottom-up analysis of their production profiles and energy requirements. In terms of business as usual, we expect a short-term increase in emissions through production growth, followed by a decline from 2025 through life of mine closures and grid decarbonisation. If we overlay a science-based pathway, we're able to understand the operational decarbonisation required to contribute to limiting global warming to 1.5 degrees Celsius and adhere to science-based targets, which we plan to update in 2022, including Marikana and Scope 3. Through the introduction of demand-side energy management, renewable energy, electrification, and fuel switching opportunities, including hydrogen, we are able to demonstrate an active decarbonisation pathway. This pathway will be converted to internal annual carbon budgets prescribed at a group and segment level to inform our long-term incentive planning. Recognizing that there will be remnants hard to abate emissions towards the end of our carbon neutral journey, we have compiled a carbon offset strategy that will generate the required offsets to neutralize the remaining emissions. Combined, these elements present a definitive pathway through to carbon neutrality, supported by internal carbon budgets to drive group decarbonisation and deliver on our commitments. Due to the infrastructure and extensive energy requirements of our South African operations, combined with the carbon-intensive electricity supply from Eskom, 93% of our group greenhouse gas emissions emanate from grid-supplied electricity. Eskom also continues to pose risk to our business through above-inflation tariff increases and unreliable electricity supply. The extensive electrification of our operations, however, presents an opportunity to mitigate these risks and accelerate decarbonisation through the deployment of renewable energy. Relaxing of regulatory requirements and anticipated ability to trade electricity in South Africa has allowed us to grow our portfolio of renewable projects to 557 megawatts, including solar and wind projects. We have appointed a local project developer for our SA Gold 50 megawatt solar PV project and 2 local project developers for 3 shovel wind projects across South Africa. Steady progress is also being made in the permits and consents required for our SAPGM solar project. These projects have been structured to limit capital outlay whilst enabling significant decarbonisation and savings benefits. The total anticipated capital cost of the project is anticipated to be around 11 billion rand and will be funded by third parties through power purchase agreements. The projects will enable 25% reduction in Scope 2 emissions by 2025 and deliver substantial operational benefits. We plan to also leverage these projects to promote local socio-economic development through our Infrastructure for Impact program. The projects will also contribute in closing of the South African electricity supply deficit and bring an end to load shedding to the benefit of all South Africans and the economy. I'll now hand over to Grant. Thank you.
Thanks, Jeff. Water stewardship is the use of water in ways that are socially equitable, environmentally sustainable, and economically beneficial. We are strongly committed to comprehensive and transparent water governance, effective management of our water at site level, and collaboration to achieve responsible and sustainable water use. We have been recognised for these efforts in 2021 by the CDP. In 2021, the South African gold operations purchased 8% less potable water. Our reliance on purchased potable water at our gold operations reduced by some 1,278 million litres or 17% year on year, and 344 megalitres or 2.8% at our South African PGM operations year on year. This despite an increase in 4% and 15% in tonnes treated at the SA Gold and SA PGM operations respectively. As we move forward into 2022, we have committed to further reducing our reliance on the integrated Vaal River system, the economic muscle of Gauteng, by 15% from a 2020 base year. During 2021, we remained true to our course of water independence at our gold operations. Boreholes to supply the Cook plant completed in Q1 of 2020 and boreholes to supply Cook 2 and Cook 3 shafts in Q4 of 2021 have rendered that complex entirely independent of municipal supply. Ezulwini has also been independent of Rand Water since Q1 of 2021. Although Driefontein is already 90% independent of Rand Water, an extension to Driefontein's 20 million litre treatment plant per day by an additional 5 megalitres per day will see Driefontein's independence from municipal water supply by Q3 of this year. The Kloof water treatment plant, which forms part of the phase 1 of the operations independence drive, has reduced the reliance of the Kloof by a third, with full independence envisaged by Q1 of 2023. Our efforts to reduce water independence have not only reduced our reliance on the integrated Vaal River system, but has also had a significant saving to the gold operations of some 85 million rand per annum, or last year rather, with phase 2 of Driefontein and Kloof expected to bring an additional saving of some 50 million rand per annum going forward. Our US PGM operations are located in water-rich catchments and have similar challenges to the SA Gold operations in respect of managing the risks associated with water pumping, treatment of the water and the discharging into a pristine environment. The newly installed disc filters at the Stillwater mine and East Boulder mine have demonstrated our ability to move beyond compliance with an average of 30% removal of the total nitrogen and 45% removal of metals from those compliance levels. At the SA Gold operations, following the installation of the Cook surface treatment plant to replace the underground treatment strategy, the Cook number 1 and 2 shaft water quality has shown a 9% improvement in water quality year on year. The threat of theft, vandalism and sabotage, however, remain a concern. On the 13th of December 2021, the Department of Mineral Resources and Energy granted Rand Uranium the environmental authorization for the rehabilitation, decommissioning and closure of our Cook shafts. That's Cook 1, 2 and 3, which means we are a step closer to closing those operations and removing some 300 million rand care and maintenance costs from those operations. Neil, I think I'd leave it there and over to you. Thanks very much.
Thank you, Jevon, and thank you, Grant. As I indicated at the beginning of the presentation, we do use our annual results presentation to provide you with further strategic updates. I want to just start with our existing strategic focus areas or pillars, as we refer to them. You see them in the diagram on the right-hand side. They are well known, they have been consistently applied, and being strategically managed, in my mind, is very important for success. And of course, if you have a good strategy, you should have exceptional success. And I'm very pleased to report that the strategy you see on the right-hand side has resulted in record annual adjusted EBITDA of 68.6 billion, or $4.6 billion. We've achieved 80% higher adjusted free cash flow of 37.4 billion rand, or $2.3 billion, and that's ultimately or predominantly, I should say, by focusing on safe production and operational excellence, and having made the moves that we did make into commodities at a point in the cycle that was very beneficial to our shareholders. I think in addition, our capital allocation model has been a good guide, and we redeemed our 2022 and 2025 bonds. We replaced that with 1.2 billion notes due in 2026 and 2029. And important, that was done with $169 million of lower interest burden. So it was done at much better rates. You would also see from this results, and Charles will cover this in more detail, we've declared an additional dividend, but the total dividend for the year will amount to just under 14 billion rand, or $866 million for the 2021 year, and that is a 9.8% dividend yield. So that is certainly class leading. In addition, our capital allocation model also refers to share buybacks, and some of our shareholders do believe that share buybacks are important. We do as well. So in addition to the dividend, we have also purchased 5% of our shares at a share price much lower than where it is today. That amounted to 8.5 billion rand, or just under $600 million. So again, we've applied our capital allocation framework and model, which is part of our previous strategy and will remain part of the new strategy. The net result is we do have a robust balance sheet with a net cash position of 11.5 billion rand, or just over $700 million. And of course, as I've just mentioned before I hand it over to Jevon, we've advanced our green metal strategy with 4 acquisitions. To me, that is the result of being strategically managed, and that is why we put effort into being at the forefront of understanding the environment and developing strategies that put us in a good spot to create value. So let me talk about the strategic refresh that we undertook late last year. And we undertook this strategic refresh with a view to raising the bar and moving our strategy to a higher level. And the environmental scan, which is always important in terms of strategy, really looked at the evolution around the industrial revolutions. And what was very clear to us, the industrial revolutions of the first, the second, and the third were good for humanity, but they were tough on humans and hard on the environment. There's been an exponential increase in urbanization, and with an increase in urbanization, of course, there are climate change issues, there are pandemic issues, and clearly we cannot continue in the same way. And certainly the fourth industrial revolution is now rapidly being replaced with the fifth industrial revolution, which is a conscious rewiring and prioritizes the needs of human beings the environment and society. And as you know, from our previous visions and our business purpose, we are a company that is very focused on people and the environment and those softer issues. So this has really been the background to the way we address the strategic refresh. Now, we also know that we have been through incredible change in a very short period of time, plus incredible challenges related to COVID-19, and in fact we've become aware of what we call grey elephants that are going to shape the fifth industrial revolution. And a grey elephant is a highly probable, high impact yet neglected catalyst or force of change. So not only are these grey elephants a challenge, but they're also catalysts for change. And we certainly used the COVID-19 grey elephant to change many things, I believe, for the better in our business. But important to note that COVID-19 is a grey elephant, and the pandemic was a catalyst agitating and amplifying several other grey elephants. So we've identified them. I'm going to share them with you now. And the bottom line is we must be prepared for these future grey elephants to recognize and take advantage of the opportunities they present. So it's not just about challenges, it's about the opportunities that these grey elephants present. So let me just work through them, and I will very briefly link them to how they have impacted on our strategy. So I've already mentioned pandemics as being a grey elephant that was predicted, and no one took any notice of that. We've all experienced how difficult it's been, how it's affected our own personal lives, how it's affected our business, and how it's affected many people around us. Very sadly, the World Health Organization predicts a number of pandemics in the 2020s, and it's mainly related to urbanization. And these pandemics are highly probable and can come from anywhere. The bottom line for business is if this turns out to be true, we need to develop a business that is pandemic resilient, and I can certainly share with you how we do that practically and how we are positioning for that. I think the issue of aging is another grey elephant, and the world is aging fast. For the first time in history, there are already more old people over the age of 60 is considered old than younger people that's under the age of 5. In fact, there's a 400% increase of people turning 100. And by 2030, older persons will outnumber children aged 0 to 9. That's a classification of children. So we need as a business to recognize this, and we need to cater for an older workforce. And of course, we link that to becoming bionic, and I'll talk more about bionic a bit later. And of course, bionic starts linking to also preparing yourself for being pandemic resilient. One of the better known grey elephants, although some people still dispute the issue of climate change, is what we refer to as the angry planet. And what I am going to say is just about every one of these grey elephants lead to angry people. And the climate emergency has no nationality, no race, no sexual preference, and certainly no political or religious affiliation. It's real, and the transition we are in will create completely new global tensions. And again, like with most of these things, it's the poorer people in the world that suffer from an angry planet. And as a business, we have adjusted our strategy to build a climate change resilient business, and in fact to provide metals that are at the forefront of reversing climate change. And I will expand on that a bit later as well. Inequality is growing. Africa is expected to account for 9 out of 10 of the poorest people in 2030, and of course we need to deal with inequality. It does again affect the poorest people. We need to recognize, especially in our South African and Southern African business, that this is a huge issue, and you will see from the adjustments to our capital allocation framework, we are going to make a very conscious and significant effort to spend money in social upliftment. The next grey elephant is, we call it a big squeeze, and the world is being squeezed. There's absolutely no doubt, from a shortage of fuel, microchips, which we all know impacted the PGM business last year and is still having an impact, water and food shortages, skilled talent, retirement, inflation and interest rates. We're all being squeezed. So we have to, if we are going to address things like pandemics and address the angry planet issues, we need to position our business within like-minded ecosystems where people have similar views, and therefore we can work together and we can develop pandemic resilience. We can provide metals and solutions to end users so that we avoid the big squeezes. Another grey elephant, and it's a common to all of these, is angry people, and the acts of consuming endless processions of negative online news to social unrest globally. Anger is on the rise. We have to address this by creating shared value and developing a common purpose. Angry people are either going to make us or break us. So we cannot ignore things like inequality, big squeezes where again poor people are affected the most. And then multipolarity, and I think this last week or so we see globalization unraveling. Russia is in the Ukraine, testing the West resolves. China will increase its competition directly with the US. Power and influence will shift. And again, it's about positioning our business like we have in like-minded ecosystems, such as building our battery metals profile in Europe and North America. That's practically how you deal with that. Then the next grey elephant is intelligent advances, and this is really about advances in robotics, artificial intelligence, machine learning, and that's ushered in a new age, and we can do what we did in previous industrial revolutions. We can introduce this without due concern to people. That will be exactly the wrong way to go. We need to introduce this intelligence and technology in a way that is constructive and recognizes people, and we talk about being bionic, where we focus on the people aspect. So you can see how these concepts have a lot of commonality and have informed our strategic thinking looking forward. So there is the complete picture, and we have revised or refreshed our strategy to take account of these grey elephants. So we are very clear on what we need to adapt for. So as I said, our previous strategy has been very successful, and it does not mean we're throwing it out and have started with a new strategy. In fact, we have developed what we call a three-dimensional strategy, keeping the good from our previous strategy, but also developing something that is going to differentiate us in many respects. So The first thing, our strategic foundation hasn't changed. Our purpose used to be improving lives through our mining. I think the purpose has been refined to safeguard global sustainability through our metals and energy solutions. Our vision used to be creating superior value for all our stakeholders. The vision has been slightly refined to be a leader in superior shared value. We've introduced the word shared value for all stakeholders and to support climate change reversal. Those are higher level purposes. That is our higher level vision. And of course, our CARES values, commitment, accountability, respect, enabling and safe production remain our values. And of course, ESG and shared value actually becomes even more dominant. That is our strategic foundation. That's why we exist, and that is what we want to impact on. So that is very similar, but we've raised the bar. Now, probably most of you would have seen Larry Fink's letter to CEOs, and I must say it was an excellent letter. And Larry's, one of his comments, is most appropriate. It's never been more appropriate for CEOs to have a consistent and a clear purpose. And there you see it. There's our impact and our strategic foundation. Just moving on to things that currently sit in our current strategy, we believe they've become strategic essentials. You have to ensure safety and well-being. You don't have to make that a strategy. You have to prosper in every region in which you operate. That doesn't have to be a strategy. That is a given. Achieving operational excellence, which was a very important part of our previous strategy, is a given. That has to continue. Optimizing long-term resource value has to continue. Maintaining a profitable business and optimizing capital allocation, those are administrative issues. They are not strategies in their own right. They are a given. So what is new? And again, it's almost it's a slight repositioning. Now, these are the strategic differentiators. These are the new aspects that we will focus on and have elevated some of the strategic focus areas from our previous strategy. So first of all, ESG excellence, that has been refined into being recognized as a force for good, and I know that that's many companies use this force for good, but I think based on our purpose and our vision, you can see the underlying substance behind being recognized as a force for good. Building a global portfolio of green metals and energy solutions that reverse climate change is going to differentiate us. We have a unique combination of battery metals and a very substantial PGM business that will in future underpin the hydrogen economy. Taking account of some of those grey elephants, we have to become more inclusive, we have to become more diverse and bionic, and I explained the importance of those. So that really enhances our cultural change initiative. And then, of course, building pandemic resilient ecosystems and being part of those ecosystems are what's also going to allow us to prosper in regions such as Europe and North America, but also not be disrupted by pandemics. It's going to be important to provide metals that are necessary to reverse climate change in those ecosystems. So those are our strategic differentiators. And just in case you were wondering, had we covered all the grey elephants, this matrix shows you that every grey elephant is covered in most cases by more than at least two of these strategic differentiators. So I'm comfortable that the environmental scan and the refresh strategy will certainly take account of these and will put us on the front foot. So at this stage, I'm going to hand over to Richard, who will go through the really good results that were achieved at an operational level. So thank you, Richard.
Thank you very much, Neil, and good afternoon and good morning, ladies and gentlemen. It's a real pleasure today to be able to share with you our operating results from the second half of last year. I think as many of you would have been aware, we recently published our updated mineral resources and reserves as at the 31st of December. I think just to highlight before we get into the details that we have had a change in the way that we report our mineral resources and reserves, and this has specifically had an impact on our South African operations, where historically we reported attributable resources and reserves based on a effective financial interest, whereas now we are basing that attributable number on an effective legal or equity interest, as of course the financial liabilities do change year on year. I think very important to highlight this has got absolutely no impact on the underlying resources and reserve numbers for the operations. Neither does it have an impact on the financial exposure Sibanye has to these assets. It is just the attributable portion that changes. I think very pleasing in the numbers is that at both our South African PGM and our US PGM operations, we saw a slight increase in reserve numbers, which effectively means our ongoing exploration more than replaced what we depleted during 2021. In our gold operations, we saw about a 700,000 ounce decrease in total reserves on a 100% attributable basis, so marginally less than what we depleted during the course of last year. The 72.5 million ounce reserve base that we have underpins a very sustainable portfolio. Our South African gold operations have lives of mines that vary from 4 years at Beatrix to in excess of 10 years at Driefontein and Kloof, and our gold projects have lives well in excess of 20 years. Our PGM operations generally have lives well in excess of 15 years, with our US operations in Rustenburg in particular having lives well beyond 30 years. So a very sustainable portfolio and underpinned by a significant mineral resource base for future replacement and growth. I think also very exciting is for the first time we are declaring resources as a result of our entry into the green metals last year. And in particular, our lithium resources at our Keliber project in Europe and our Rhyolite Ridge project in Nevada, maiden resources for the first time there, and zinc as well through our exposure to New Century Resources in Australia. Our uranium resources in South Africa remain unchanged, and those are currently currently under economic studies. And of course, we also report our copper resources in Argentina, in South America at our Altar project. Moving on to our South African PGM operations, very pleasingly, they continued with a great performance during the second half of last year. Total production from these operations amounted to just in excess of 940,000 ounces for the half year, and 5% higher than the comparative period the year before. But I think particularly pleasing was the strict control that we maintained over our costs resulted in a nominal 1% lower unit cost year on year. And for the year, we came in at around 17,000 Rand per 4E ounce. We sold just under 960,000 ounces of PGMs, and that was at an average basket price of just over 40,000 Rand per 4E ounce, marginally higher year on year. This equated to a free cash flow out of these operations for the second half of the year of just over 8.2 billion, significantly higher than the comparative period last year, and a very healthy 54% adjusted EBITDA margin, despite the drop-off in the PGM prices towards the back end of 2021. Our sustained and very disciplined focus on costs has meant that we have seen our operations gradually move down the cost curve, and we now have a portfolio of PGM assets that sit squarely within the second and third cost quartiles. And I dare say look forward to seeing that move to the left continue in the years to come. An important announcement at the beginning of this year was the agreement that we've reached with Anglo American Platinum on the PSA transaction, on the PSA assets. Essentially what this transaction is about is that we will ultimately take over the infrastructure of the PSA, including the rehabilitation liabilities. And how the transaction will work is that those conditions, or the transaction, will close once we have delivered 1.35 million ounces into the PSA under the current PSA terms, as well as got the required regulatory approvals from the Competition Commission and the DMRE. Important to note is that the 1.35 million ounces that actually started counting from January of last year. So as at the beginning of this year, there was marginally under 900,000 ounces that still needed to be delivered. Once these conditions have been fulfilled, we will then take over the infrastructure, and the POC arrangement will convert into a toll arrangement on terms similar to the current Rustenburg toll. I think this is a transaction that's created significant value for all stakeholders. In the short term and immediately, it allows the PSA to consider mine planning across mine boundaries. And that, of course, allows us to optimize operational flexibility and efficiency through those mine plans. I think in the medium term, it allows or it creates an additional 1.8 million ounces of reserves at Rustenburg. And this was effectively ground that couldn't be accessed through Rustenburg infrastructure that will now be mined through the PSA infrastructure. In addition, a lot of the Rustenburg reserves that were going to be mined through Rustenburg infrastructure at the back end of the life can now be extracted far earlier through the PSA. And of course, for local stakeholders, a key value is that we've almost doubled the life of the Kroondal operations, with the longest life shaft being extended for up to 16 years. And of course, that means sustained employment and optimal return out of this infrastructure, which benefits all stakeholders. For Sibanye-Stillwater, we estimate that this transaction has about a 6 billion rand value uplift for our company. The US PGM operations had a tough second half to the year, and this was following a very tragic fatal accident that we suffered in June. The production out of these operations was approximately 270,000 ounces for the second half of the year, which was about 11% lower than the comparative period in the year before. The lower production output, combined with inflationary pressures and rising inflation in the US environment, together with the need to bring in higher contractors to supplement skill shortages that we're suffering in the area, all resulted in a year-on-year 18% increase in unit costs to just over $1,000 per ounce for the year, and just under $1,040 for the second half. The operations battled with several operational constraints during the fourth quarter in particular, which largely have been dealt with. But in the medium term, we will continue to suffer constraints, predominantly as a result of revised operating procedures post the fatal accident. And what that has really meant is that we cannot have people in rubber-tired vehicles operating in rail ends at the same time as rail equipment. This has had a significant impact on our mining efficiencies, particularly at Stillwater West. That is likely to continue into the medium term until such time as we have fully installed proximity detection systems that will allow us to operate under a new procedure in that area. In addition, I think like much of the US, Montana currently has a very low, in fact, a negative unemployment rate. And as a result of that, there is a dearth of skills in the region at the moment, and attracting skills and experiencing high attrition rates on our employee and workforce has been a challenge during the course of the year. As a result of these constraints, and we do foresee them continuing into the medium term, we will be reassessing what the optimal operational output is from the Stillwater assets over the coming months, taking these constraints into account, as well as our forecast for the medium-term palladium market conditions. Pleasingly was the conclusion of a 3-year wage agreement at East Boulder, which was a sustainable agreement, and my compliments to the team and the unions for a constructive engagement during that process. The PGM recycling continued to deliver significant value despite some real challenges during the second half of last year, particularly logistic challenges associated with COVID and moving spent auto catalysts around the country. But in addition, there was also a significantly reduced amount of vehicle scrappage, that due to less new car sales as a result of the chip shortages that we saw during the course of last year. That meant in total we fed just over 350,000 ounces during the half, but we were also able to process a significant amount of our inventory, therefore unlocking working capital of about $380 million over the period. Our recycling inventory at the end of the period was at about 25 tonnes, which we see normalising around 200 tonnes as we built up during the course of this year. This output resulted in just over $50 million of adjusted EBITDA, with an additional $9 million of interest earned from advances to our recycling customers. Moving on to our South African gold operations, under the circumstances of some very tough safety interventions, self-imposed many of them, under those circumstances our gold operations managed to sustain a steady output and produced for the half just over 550,000 ounces, which was 4% lower than the comparative period to last year. The lower output and significant inflationary cost pressures, in particular from Eskom, steel and chemicals, as well as catching up capital in the form of ore reserve development and sustaining capital that was underspent during 2020 as a result of COVID, resulted in a total 16% increase in unit costs to 814,000 Rand per kilogram. ERD production was 3% lower and at 10% higher costs, and that combined with an average Rand gold price of 860,000 Rand per kilogram, some 11% lower than last year, resulted in our EBITDA being 2.8 billion, or just under half of what we achieved over the comparative period. Nevertheless, this is still an 18% adjusted EBITDA margin. As many of you would be aware, we are continuing with wage negotiations at our South African gold operations. In December of last year, under modelling that was undertaken on our TSF, together with ourselves and our engineers at record, identified a risk due to excessive pore pressures at our Beatrix tailings facility. And this modelling, combined with the excessive rain that we were experiencing at the time, led us to make a decision to stop deposition onto this tailings facility until rehabilitation work had been undertaken. That rehabilitation work includes the building of a buttress wall in the area recognised as high risk on the tailings dam. We anticipate that this rehabilitation will be completed by the end of March. During this period, underground production is continuing at Beatrix, and that ore is being stockpiled, and we expect to be able to treat all of that stockpiled ore during the second and third quarters of this year. So in terms of annual guidance, starting off with our US PGM operations and clearly taking into account the constraints which we are currently operating under, we forecast production for this year to be between 550 and 580,000 ounces. As I mentioned, this is currently being assessed to determine what the optimal output should be in the medium term. All-in sustaining costs at those levels would equate to around $1,000 per 2E ounce, and capital is estimated at around $300 million, which includes $70 million of project capital. Our US recycling is forecast to be largely flat at between 750 and 800,000 ounces, and similarly at our South African PGM operations, we're forecasting flat production at between 1.75 and 1.85 million ounces at a cost of between 18.5 and 19,000 Rand per 4E ounce. Capital at our PGM operations is marginally higher at 4.7 billion, and that includes R1 billion of project capital being spent on our K4 project. At our South African gold operations, we had a self-imposed safety stoppage at Beatrix. Beatrix operations only commenced production in February of this year, and as a result, we are lowering guidance for our gold operations to between 25 and 27 tonnes of gold. The lower production and the stoppage at Beatrix does mean that we are anticipating higher unit costs, and currently we're forecasting between 875 and 925,000 Rand per kilogram. Capital is marginally lower, having caught up much of the ore reserve development and SIB capital last year from 2020, and that is forecast at about 5.2 billion rand and includes 1.5 billion rand for the Burnstone project and 350 million rand for the continuation of our Kloof 4 decline project. Thank you very much, and I will now hand over to Charles for the financial review.
Thank you, Richard. Good afternoon and good morning to all participants on the call. It once again gives me great pleasure to share the excellent financial results with you for the year ended December 2021. Next slide. Starting with the income statement, revenue increased 35% from 127 billion rand in 2020 to 172 billion rand in 2021, following the continued strong performance of PGM prices. Interesting to note, compared to 2019, revenue increased by 100 billion rand or 136%. Cost of sales were up 33% from 76 billion rand in 2020 to 101 billion rand in 2021. Most of the cost increases, excluding the year-on-year above inflation increases in labour, electricity and consumables, related to an increase in recycling costs of 14.8 billion rand, which is directly linked to the increase in the recycling PGM basket price. The recycling PGM basket price increased from $2,200 per 3E ounce to about $3,500 per 3E ounce. The balance of the cost increases was due to the very profitable, albeit higher cost of purchase of concentrate at our SA PGM operations amounting to 3.2 billion rand. The result of the aforementioned is that EBITDA increased 40% year-on-year to 69 billion rand. If we now turn our attention to the standout items for the year, net finance expenses were down from 2.1 billion rand to 1.3 billion rand in 2021, mainly due to lower average debt for the period and higher cash balances. For the period, we recognized a loss on financial instruments, which were mainly made up of the following. A 4.7 billion loss on the Rustenburg deferred payment was realized. The loss is primarily driven by the significant increase in the 2021 actual profitability. The balance being changes in the future consensus PGM input prices used to value these liabilities. Just as a reminder, this liability is calculated at 35% of distributable free cash flow generated by the Rustenburg asset over a 6-year period ending in December 2022. The balance of the loss on financial instruments were due to the Rustenburg and Marikana BEE share-based payment obligations that increased 1.3 billion rand, also driven by the changes in future consensus PGM input prices. A write-down or impairment of our SA gold assets of just over 5 billion rand was recognized at year-end. At 31 December 2021, a number of factors, including above inflation wages and electricity prices, were identified that negatively impacts the ability of the Driefontein, Kloof and Beatrix operations to recover the carrying value of mining assets over their respective remaining life of mines. Additionally, an assumed long-term gold price forecast, and this is based on sell-side analyst consensus of approximately 750,000 rand per kilogram or $1,500 per ounce in real terms, negatively affected the forecast cash flows from these operations. This led to the recognition of impairment losses at the Driefontein, Kloof and Beatrix reportable segments. Royalties at 2.7 billion rand and mining and income tax of 13.7 billion rand increased 54% and 183% respectively. The increase in mining and income tax was due to the significant increase in profitability and the recognition of the previously unrecognized deferred tax asset at Marikana. After accounting for all of the aforementioned, profit amounted to 34 billion rand. Headline earnings for 2021 were approximately 37 billion rand compared to 29 billion rand in 2020. Headline earnings per share for the period was 1,272 cents per share. Next slide. The debt and liquidity maturity profile highlights that we now have a deferred, low-risk maturity ladder. At period end, the $600 million and Rand 5.5 billion RCF facilities were fully repaid, and the only outstanding debt with recourse to the balance sheet was the $1.2 billion bond issued in November 2021. It is worth noting that the bonds that were issued in November was not only upsized to $1.2 billion, but will also result in an approximately $170 million of interest or coupon savings on a like-for-like basis, compared to the 2022 and the 2025 bonds that were issued in 2017. The US dollar RCF matures in April 2023 and the Rand RCF matures in November 2024, and these will be extended or refinanced well ahead of these maturities. Liquidity headroom at the end of the year stood at 48 billion rand and consisted of 30 billion rand in cash and the balance of 18 billion in undrawn facilities. Next slide. The dividend momentum was maintained at the upper limit of our dividend policy. The final dividend for half 2 2021 was 187 cents per share, bringing the full year dividend to 479 cents per share, a 30% increase year on year and a yield of over 10%. Returns to shareholders for the 2021 year amounted to 22.3 billion rand and was split 13.8 billion rand in dividends and 8.5 billion rand in share buybacks. Thank you. Next slide. This table illustrates the clear value proposition of Sibanye-Stillwater, looking through the lens of return of capital to shareholders. From a dividend yield perspective, Sibanye-Stillwater came in at the #1 position, closely followed by our South African PGM peers. If we include buybacks and we look at total returns to shareholders on an absolute basis, we still came in at the #3 spot. However, measured in market capitalization, Sibanye-Stillwater ranks in the #6 position of the gold and PGM peers presented on the slide. Moving on to the next slide. We continue our disciplined delivery on all aspects of our capital allocation framework. Looking at the performance for 2021, we achieved or exceeded our capital allocation priorities as measured in each of the capital allocation buckets. We have further refined our capital allocation framework, and I would like to highlight 2 additions to the capital allocation framework. The first is the renaming of the dividend bucket to the stakeholder shared value bucket. The change here is that we have looked at various funding mechanisms for social upliftment projects, and to ensure that this is based on profitability and aligned to our other important stakeholder, being our shareholders, we have decided that at each dividend declaration, we would like to set aside an amount equivalent to 1.5% of the dividend declared to fund these extremely important ESG initiatives. The second change or addition is the inclusion of a new innovation and market development research and development fund named the Bionic Cube. This was agreed to by the board of directors, and on an annual basis, we will allocate up to 1.5% of EBITDA, subject to strict investment criteria. We believe that these 2 important factors further strengthens our disciplined capital allocation. I would now like to hand back to Neil, who will take us through the outlook and the conclusion. Thank you, Neil.
Thank you, Richard, and thank you, Charles. I'm going to just complete the presentation with a brief outlook and conclusion. So there are experts in PGMs, there are experts in battery electric vehicle forecasts, and I don't intend to try and portray myself as an expert. We understand the supply and demand side of these metals very clearly, and I don't want to repeat what is obviously good work done by many other people, but I do want to provide you with our view at a high level regarding perhaps a slightly different view. We believe PGM demand will remain well supported well into the 2030s, and it's predominantly because internal combustion engine vehicles have a substantial future, much more than what I think is being given credit to, and it's because the forecasts of the penetration rates of battery electric vehicles is, in my view, substantially overstated. And yes, I do know that a lot of this has been legislated, but when we are not able to provide the metals required for batteries, I do suggest that governments will revisit their legislation to take account of that. But in addition, there are tightening emissions regulations which will support PGM demand. And I would also say that I do believe that technology regarding internal combustion engines will also improve. The growth in heavy-duty fuel cell electric vehicles will also underpin PGM demand. And then, of course, in the longer term, the hydrogen economy will really provide that demand underpin post 2030. So the outlooks for PGMs remain constructive and robust. As I've said, on the battery metals, there's a very aggressive market forecasts, and those are going to be tempered by battery metal supply constraints. I think, we talk generically about lithium and nickel, but there are very specific requirements for battery grade lithium hydroxide that's already in a deficit in 2021, and that deficit is going to deepen substantially. Nickel prices and nickel sulfate is of course the requirement or battery precursor. Nickel is at all-time highs as demand clearly outstrips supply. So I do see major constraints, and I do think despite nickel prices being elevated, despite lithium prices being high, these are still lows in this battery metal cycle. So let me then conclude, and you will notice the heading is adapt or die. And as I said right at the beginning, our strategies have served us very well, and they've in fact delivered the results that you've seen today. So our strategic delivery, we do what we say we will do. It's not always popular, but we do what we say we will do, and it's really worked to our benefit. We've delivered record annual earnings. We have a well-timed entry into the green metal sector. As I've said, I believe there's a lot of upside on battery metal prices, which is also going to constrain the penetration rates of battery electric vehicles. We're delivering on all elements of our capital allocation framework. You've seen that in terms of our dividend. You've seen that in terms of our share buyback. You've also seen refinements to our capital allocation framework, and very importantly, together with shareholders, we are making commitments to invest in social upliftment, to avoid angry people and be a force for good. And you've also seen us enhance our approach to market development, research and development, through our Bionic Cube Fund. We've been very focused and disciplined on M&A. If we can't grow in the battery metal space because we can't create value, we won't do it. But we will not compromise on value and achieving our hurdle rates. And I think you've seen clear evidence of that. Our new refresh strategy is enhanced, and it's enhanced our strategic positioning for future resilience and I believe success. It's a class-leading strategy. It's a 10 to 15 year strategy. We've raised the bar in just about every area that we have a strategic focus. So I have no doubt we will be a force for good. And then just again, Larry Fink, in his letter, which you can read on the internet, he said, I believe the decarbonizing of the global economy is going to create the greatest investment opportunity of our lifetime. It will also leave behind the companies that don't adapt, regardless of what industry they are in. And I think Larry Fink is spot on, and we are certainly going to be one of those companies that prosper in this environment. So at this stage, thank you for your time. I hope you found all the submissions and presentations interesting. I am going to hand over to James Wellstead to facilitate the question and answer session. Thank you, James.